Hey, welcome back to this series for beginners. This is part one, understanding financial markets. All right, so we're going to do an overview of financial markets. What are stocks, bonds, Forex, commodities, futures, and who are the market participants, retail traders, institutional traders, and smart money? Let's get right into it. All right. So the very first thing that I got into back in 2014 was stocks. So I didn't really learn what that was in school. Nobody really told me anything about it. My dad, who worked for Halliburton, an oil company, he told me every once in a while that he was buying company shares or whatever. And I kept asking, I'm like, what is that? I don't understand. And he said, well, it's like owning a piece of a company. I said, all right, well, that doesn't really tell me a lot, but okay. Like, what is a stock? What is the stock market? Now, for that, what we're going to do, instead of taking my word for it, is we're going to go and head over to a pretty credible website called Investopedia. All right. So they'll be able to explain things a little bit better, with citations and all that kind of stuff. So, what is the stock market and how does it work? Well, the stock market as a whole is an exchange mechanism that helps investors buy or sell shares in publicly traded companies. Though you can visit the New York Stock Exchange, the NYSE, and offices of the NASDAQ, there are just components in a broader, or excuse me, these are just components in a broader marketplace. Trades are conducted mostly through electronic means between participants who are remote from each other. So, like, for example, if you have a cell phone, there are apps that you can download where you can, purchase or sell stocks and stuff like that. Webull, Robinhood, things like that. Not a broker recommendation, but those are options available for you. So it's basically where we go to buy and sell stocks. Okay. That's what the stock market is. And so pretty much most people can buy or sell stocks. There are certain requirements, but you don't have to go to school for this stuff. You don't have to, have a degree in order to just buy or sell stock. Most people who have a job and if they contribute to their 401k, that's pretty much what they're doing. They're buying stock or something like an ETF with their retirement plan. So most people are part of the stock market, even though they may not even know, half of what this really is. So you can read the rest of it on your own if you like, but basically you're going to buy and sell shares of a company. Okay. Now, obviously, what is the goal? The goal is to buy stocks when they're low and sell them at a higher price, right? That's how you would profit essentially. But we're going to get more into that later. But for now, that's what the stock market is a exchange, right? Where most of it is done electronically. Next up, we'll go over the Forex market. I did have bonds on here. I took that off because I don't really trade bonds. They are important, but I'm just not going to go over that in this series. So we've scratched that. I'm going to move over to Forex. All right. So the Forex market definition, how it works, types, and the trading risks. So the Forex market is where banks, funds, and even individuals like you and I can buy or sell currencies for hedging and speculation. Now, hedging means that you don't really want to risk anything like that. So you want to hedge yourself. Now, speculation is where you're taking on risk. That's where you want to buy low, sell high, and stuff like that. Whereas hedging is different. Okay. So Forex, also known as foreign exchange, is a market where banks and individuals buy or sell currencies. It's like the stock market, but for currencies only. All right. It's the largest financial market in the world, according to the latest reliable data from 2022, when global daily trading was around $7.5 trillion. Now, stuff like that, to me, I don't really use that information. I think it's cool, I guess, but you're not going to have issues with liquidity as a retail trader. Like, it's probably not going to happen. So I don't really recommend to write all that stuff down. Oh, it's the largest market. It trades this much. I don't really care about that. But the important stuff is to know that it is made up of banks, commercial companies, central banks. That's very important. That's who the smart money is. And we'll get more into that later. Investment management firms, hedge funds, and then retail Forex brokers and investors. Okay. And all that good stuff. So the Forex market operates 24 hours a day, 5 days a week. And so it closes on Friday afternoon, opens up on Sunday evening. So you can't really trade like Saturday, Sunday mostly, but definitely during the week you can do that. Under the most traded currencies, this I would definitely say is pretty important. The US dollar, euro, yen, British pound, and the won, and then everything else is thrown in here. But dollar index, that is very, very important. Next, we'll move over into commodities. Commodities are super important. They're an important aspect of Americans' daily, well, really everyone's daily lives, not just Americans, but providing the food they eat and the energy used to propel their cars. A commodity is a basic good traded in large volumes and interchangeable with other goods of the same type. Commodities are either for immediate delivery in spot trading or for convenience later when traded as futures. More on that later. Commodity markets deal in metals like aluminum, copper, gold, lead, nickel, silver, zinc, and others. The only thing I really pay attention to is gold and silver. Over the years, I've done a lot of videos on that. I still have physical silver, by the way. And then we have commodity softs like cocoa, coffee, sugar, oil, etc. So I had a coffee earlier today, and that is a real commodity, right? Coffee beans, stuff like that. Same thing with sugar. Most of the food in America is filled with sugar, okay? And that's that. So basically your metals, oil, gas, stuff like that. Next up, we're going to talk about one of my favorites, futures. So futures contract definition. A futures contract is a legal agreement to buy or sell a particular commodity, asset, or security at a predetermined price at a specified time in the future. Futures contracts are standardized for quality and quantity to facilitate trading on a futures exchange. The buyer of a futures contract is taking on the obligation to buy and receive the underlying asset when the futures contract expires. The seller of the futures contract is taking on the obligation to provide and deliver the underlying asset at the expiration date. Now, when I trade futures, I do not hold through expiry. So I'm typically a day trader, so I probably won't even hold overnight, but you can hold trades or contracts to expiry. I just typically don't do that. But you can trade futures on a lot of things, right? There are tradable futures contracts for almost any commodity imaginable, such as grain, livestock, energy, currencies, and even securities. So I predominantly say the futures that I trade are index futures. So that's going to be ES, YM, and Q, which is like the S&P 500, NASDAQ, and the Dow Jones. And in the US, futures contracts are regulated by the CFTC, otherwise known as the Commodity Futures Trading Commission. All right, so there is a quick overview of financial markets, what the stock market is, what the Forex market is, what commodities are, and what futures are. And now we'll move into the market participants. First up, retail traders. Retail traders, often referred to as individual traders like myself and probably you that's watching this video. We are individual traders, buy or sell securities for our personal accounts. Institutional traders buy and sell securities for accounts they manage for a group or institution. Pension funds, mutual fund families, insurance companies, and ETFs are common institutional traders. So basically, a retail trader is just someone who trades their own account. It could be a small, like $100, $500, or $1,000 account, all the way up to however much. But no matter what size account that you or I have, it could be millions of dollars, but it's still going to be a small account because retail traders don't move markets. That's important. We'll get more into that later on down the road, but I did tell you about central banks, right? And how that was important. You need to highlight that in your notes, or if you're going to get this PDF, then you need to highlight that. But basically, most of us are retail traders, okay? Now, the institutional traders, we do want to follow what they're doing to a degree, and I'll teach you that eventually in the later videos. But even themselves don't really move markets for the most part. They can move the markets, I think, but when it comes to like stops and stuff like that, which again we will get into, it is good to know or to estimate where we believe as retail traders where institutional traders are trading. Okay, so we will come back to that, and this is very important. But big money, right? That's where the market goes. And so where institutional traders are trading around or have their stops near, that's going to be important. And that's really what moves the markets. So that, and it's all based on liquidity. It's based on an algorithm or algorithms that move price. But we'll get to the charts way later on down in the road. But that is very important for you to know. And while we're here, we're going to go over that. Okay. So retail traders typically invest in stocks, bonds, options, and futures, and they have minimal to no access to IPOs, just initial public offerings, like basically stocks that haven't hit the market yet. I'm not going to do too much on that. I'm surprised they didn't add Forex in here, but retail traders can trade Forex as well. Okay. Now, since that website had both on there, what the retail traders are and what the institutional traders are, I went ahead and threw both of those definitions in there, and the link in the first one, but it's the same link for both. Now we can get to my favorite part, the smart money. Now, the smart money is a term that you're going to hear all over the internet in today's world, but it's really not anything new per se. It's actually a very old term, smart money. Now, you can go to these websites, you can read all this stuff. A lot of it on this page I do think is wrong, but there's one key element here that I would make sure to annotate, which is right here. Smart money also refers to the collective force of big money that can move markets. In this right here, in this context, the central bank is the force behind smart money, and individual traders are riding the coattails of the smart money. So that's exactly what we want to do. Okay. Where as a smart money trader, right? Smart money concepts that's what we're doing, is we want to align ourselves with the smart money. But who is that? That is the central banks. Okay. Central banks right there. Okay. So again, you want to make sure you highlight that in your notes, or if you're writing them down, you want to highlight that smart money is the central banks. Okay. And there we have it. There's your brief overview of what the stock market is, the Forex market, what commodities are, what futures are, the market participants, retail traders like you and I, institutional traders might be like banks, insurance companies, stuff like that, and smart money, the central banks. All right. So hopefully you guys learned something. Drop a like on the video if you got some value. I will continue this series for that way you guys can enjoy it and watch it. So with that being said, I will see you in the next one.